Welcome to the deep dive. Today, we're tackling a really fascinating stack of analysis on the U.S. economy, market drivers, and honestly, some legislative landmines that are just waiting for us in the near future. And this deep dive isn't just about what the Fed's doing right now. It's about understanding two very distinct, massive waves of liquidity that look like they're set to crash into the global markets.
That's right. And that's the mission for you today to really synthesize this information and understand the immediate things pushing the Federal Reserve to cut rates, even when the economic conditions look a little dubious. And then we pull back the curtain on what our sources are calling the next level of money flow.
A future liquidity event.
Exactly. Something driven by a new US law that frankly dwarfs a lot of the current concerns about, small rate adjustments. We're really dissecting this policy paradox.
The struggle to help the working majority without just, I guess, handing a guaranteed bull run to the people who already hold all the assets.
That's the one.
Okay, so let's start with the immediate future. The analysis we looked at makes it very clear that the Fed is right now prioritizing the job market employment over its traditional inflation targets. We hear this a lot, but why now? Why is employment so uniquely sensitive at this moment?
Employment is critical because it's not linear. That's the key. If the real employment numbers start dropping in a serious way, then consumption falls, demand just shrinks, and that creates some very serious deflationary pressure.
Right.
But the real danger, the thing the Fed is terrified of, is that job loss has a very specific characteristic. We see it over and over again.
What is
Once it starts to get worse, it accelerates very, very rapidly. And that vulnerability makes them, let's just say, jumpy about any negative data point they see.
So they're on edge about any real deterioration. But what if the data doesn't actually justify a true recessionary cut? How do they create that window to act without signaling panic or looking like they're just ignoring inflation?
And that is where we get this fascinating, almost tactical maneuver that the analysis calls the shutdown pretext.
The shutdown pretext.
Yeah. The idea is that any temporary government instability, say a partial shutdown, it causes temporary layoffs. Federal workers, contractors, they all suddenly show up in the monthly stats as unemployed.
Even though everyone knows they'll get rehired as soon as the budget passes.
Exactly. Even though they'll be back at work in what, a month or two, that temporary spike in bad employment data gives the Fed the perfect pretext or justification to push through an insurance cut.
So they can point to the numbers and say, look, things are getting worse.
Precisely. They can point to those numbers. Our material suggests this could happen around December and make the cut while, dodging the criticism that they're being reckless with inflation.
And the analysis also mentions the job market's already kind of distorted, right? Because of shifts in immigration and other post-pandemic things.
That distortion is essential context, yes. When your baseline for labor supply and demand is already a bit strange, a small bureaucratic hiccup can look like a huge economic crack. And this all feeds directly into the political pressure to print.
Okay, this is the part I really want to unpack, the policy puzzle. Why is there this constant, almost overwhelming pressure to cut rates, even when everyone knows it risks pumping up asset prices, real estate, stocks, especially AI tech, even more?
This gets us to the absolute core structural problem that the analysis identifies: economic polarization.
Yagikwa.
Yes, the Korean term for it. It's this widening divide where, high asset prices are completely disconnected from the economic reality that most people are actually living. I mean, if you look at the general global economy, average wages, purchasing power, it's not strong, but then you look at asset markets and they are just in this persistent bull run.
And our sources link this to political sentiment.
They did. They pointed to things like election results, where you can see people are feeling this acute economic hardship, just this feeling of, I can't live like this, with the current borrowing costs and pressures.
Yeah. So the focus of policy has to shift. It goes from what's, let's say, economically ideal, like tightening money to fight inflation, to what is politically and socially necessary for the majority of people.
Correct. The consensus view for policymakers, and it doesn't matter if we're talking about Yellen or a potential Trump administration, is that policy has to serve the common person. If the majority is struggling because of high rates, then cuts become a political necessity.
And what happens to the minority holding all the assets becomes a secondary problem.
It becomes a secondary problem, yeah.
But that's the paradox, isn't it? If you lower rates to help the majority, you are simultaneously guaranteeing that the assets they don't own, especially tech and AI stocks, are going to soar even higher.
And that structurally cements the wealth gap. It gets worse.
It's a debilitating feedback loop.
It is. The very tool you use to ease the burden on the many just strengthens the financial position of the few. It's why there's so much anxiety. But we have to look beyond the Fed now.
Because the rate cuts are just the opening act.
They're just the warm up act.
Okay. We absolutely need to pivot from these incremental Fed decisions to what the analysis calls a monumental future liquidity event. Let's talk about the Genie Act.
The US stablecoin law.
Yes. Why is it being described as the most frightening future development in financial markets?
The Genie Act, which is basically the new framework for stablecoins in the US, it's a massive legislative deal. But the scary part isn't really the digital currency itself.
Okay.
It's how it completely changes who is financing America's debt. It enables something our analysis calls private quantitative easing.
Private QE. That's a huge term. How does a law about stablecoins lead to the private sector doing a job that's usually reserved for the central bank?
Okay, so here are the mechanics. It's crucial. The US government needs constant, reliable buyers for its gigantic and still growing national debt, for its treasuries.
Always.
Always. Now, stablecoins, by design, have to be stable, which means they have to be backed by very safe, liquid collateral. And in the US, that means US treasuries, overwhelmingly.
So the Genie Act provides the legal framework that basically legitimizes and scales up the creation of stablecoins.
It does. And when a private company wants to mint new stablecoins to put into the economy, they must buy the matching amount of treasuries to back that coin.
So it creates an automatic buyer for government debt.
An automated, perpetual, private demand mechanism for government debt. It injects fresh liquidity into the system, and the Fed doesn't have to do a single thing.
So the government can spend by issuing debt. And this law creates the private buyer for that debt through stablecoins. It's like an end run around the Fed's control.
It's a dual injection of money. You have the government creating money through spending and debt, and the private sector creating money through stablecoin issuance, which then has to buy that debt. That is the definition of private QE.
And it just bypasses the Fed's main tool, interest rates.
Completely. And it fundamentally changes the sheer amount of money that's going to be flowing into the system.
The timeline on this is obviously critical. When does this actually hit the markets?
Well, there's a fast track. The law officially has an 18-month clock, but it actually takes effect much, much sooner. It's 120 days after the supervisory agencies finalize all the detailed regulations.
And when is that expected?
The expectation, the one that all the commentary is watching, is that those regulations get finalized in the first half of next year.
Wow. So we could be looking at just an overwhelming liquidity flood in the latter half of next year. And it has nothing to do with the Fed's short-term rate cuts.
The volume of money will be far larger than anything caused by these little policy tweaks. It means an aggressive dilution of the value of money we already have,
Which means asset prices and everything rally.
potentially accelerating dramatically
Right.
across the board when this law gets fully implemented.
This feels like it shifts the whole dynamic from careful investing to pure speculation, what our sources called the money game. How do we tell the difference between where we are now and a true dangerous bubble?
Well, right now, if you look at high valuations in, say, the AI sector, the skepticism around those prices is actually a healthy investment viewpoint.
We're still asking questions.
We're asking questions, we're assessing risk, we're demanding to see a path to profitability. The companies still have substance, generally.
But the transition happens when this new liquidity hits.
Once that private QE hits the market, the whole system transforms. It becomes a money game. Speculation completely takes over from fundamentals.
What does that look like? What are the hallmarks of that money game phase?
Two things, really. First, you get what we always call irrational exuberance. Prices start to reflect future dreams, not any current reality.
Like the robot company example from the analysis.
Exactly. Valuing a company based on a 5-year prediction that every home will own a robot, even if the company has zero earnings today. That's a dream.
And the second characteristic.
The market is driven purely by the flood of cash. Liquidity dictates prices, not fundamentals. It's just money chasing money.
And connecting this back to real-world risk, the analysis pointed out that big tech firms are financing their huge AI buildouts by taking on a lot of debt. They're issuing bonds. That feels like the Achilles heel in all of this.
It is the single most critical variable for the next crisis.
Right.
No question. They are loading up on debt to fund this boom. But, and this is a crucial insight, all the problems related to debt only really surface when interest rates are at an absolute high level.
So the debt only breaks the system when the cost of paying for it becomes crushing.
That's it. This whole boom risky as it is, stays manageable as long as rates are coming down or staying low, the crisis only becomes truly acute when that debt burden becomes unsustainable.
And that would require rates to climb back up to an absolute high, which would probably require some other massive external shock to force the Fed's hand.
Absolutely. We have to acknowledge high rates are the ultimate trigger, but of course, massive earnings failures or, sudden regulatory shifts could certainly start some smaller debt crises earlier.
Okay, so let's summarize this for everyone listening. We have two very distinct phases to track. The immediate future is all about potential Fed rate cuts, driven by this employment pretext, and the political pressure to ease the burden of polarization.
Right.
But the longer term outlook is completely dominated by this system altering liquidity injection from the stablecoin law, the Genie Act, that's scheduled for the back half of next year.
And the synthesis is really clear. Whether it's through the Fed or through this private QE, the price of money is structurally falling. And the lower the price of money, the interest rate, the higher the value of tangible assets has to go: equities, real estate, commodities.
The next 18 months are going to be defined by navigating these two huge separate flows of cash.
And as we discussed, we know this money game eventually ends when interest rates are somehow forced back to an absolutely high level and all that debt starts to break.
Which brings us to a final, pretty profound question for you to think about as you watch the markets.
If this private quantitative easing from the Genie Act floods the market with truly unprecedented liquidity, causing asset values to just skyrocket, what external force or economic crisis could possibly be powerful enough to overcome that perpetual liquidity machine and force the Fed back into a high rate regime to pop the very bubble this new legislation created?
That is the real challenge, lying in wait.